At some point, you may have heard the phrase, buy the dip. Well, this is common during the price drop of a coin. Investment drove up the price of several crypto coins after they first gained popularity, establishing pronounced uptrends. On the other hand, traders may have a fear of missing out and opt to buy even at high prices when this occurs. Nevertheless, buying the dip enables traders to take advantage of any corrective dip in price to purchase Bitcoin at a lower price. Investing during price drops carries some risk because a little dip could signal the start of a major market meltdown. Market crashes are nothing new to Bitcoin, which has a history of correcting more than 75%, rendering buy the dip as a debatable strategy. Is your best course of action to buy the dip? Let's explore this topic further to find out. One of the most well-known financial mantras is buying the dip. It entails purchasing a stock or other item when its price has dropped. That the price drop represents a deal on the underlying asset is the prevailing opinion. When the price returns to the previous high or even exceeds it, you will stand to increase your profit margin. Typically, buying the dip is a market timing approach rather than a long-term investment strategy that is used in response to short-term price swings. However, it applies to both long and short-term markets. The extent of the dip is determined by the investor's sole plan criteria, but generally speaking, the potential returns are higher the deeper the dip. The biggest source of risk when adhering to this maxim is that a dip may not always signify a market downturn and may instead indicate an impending turnaround. The big questions are therefore what to look for when buying stocks and how to choose the best time to do so. A common trading method for the majority of financial assets on the stock market or cryptocurrency market is buying the dip. But given that Bitcoin trends tend to be very powerful and protracted, it is a particularly well-liked trading method. Because it's difficult for traders to seize opportunities as a result, they must buy at higher prices. So, waiting for a corrective downturn to occur gives traders the chance to enter the position at a lower cost and amass more coins than if they had bought them at a higher price. Dip buying can occur in all types of financial markets, including stocks, commodities, futures, FX, and cryptocurrencies. Buying the dip in cryptocurrency can, however, be different from using the tactic in other financial markets. The volatility and trends in the cryptocurrency market are typically very high. In light of this, when a corrective dip occurs in other financial markets, cryptocurrency may see a more severe correction. Take Bitcoin in 2021, for example. The value of Bitcoin doubled at the start of the year. Corrective drops were generally brief, from 18% and 31% as the price kept rising. But after Bitcoin's price crossed the $64,000 mark, a bigger drop started to take place in the summer of 2021, leading to a 55% correction. The biggest obstacle to buying the dip with cryptocurrency is this. If you buy during a 20% corrective downturn, you can later witness a 50% crash in the cryptocurrency market. A long-term investor, hodler, thinks that buying the dip just allows them to get additional coins, while cryptocurrency is still in the early stages of acceptance. Their justification is that if the price spikes significantly, their collection of coins could generate enormous money. But how does it function? The buying the dip technique is justified by the fact that markets never move in straight lines. Prices typically fluctuate in cycles, with multiple ups and downs occurring within longer-term trends. To find cyclical low points that will likely offer the best price entrance opportunities into the market and exit during cyclical high points, a buy-the-dip investor must first identify the market cycle. This is known as buying the dip and selling the rip. Investors might look to several market cycles to time the market for entrance by buying the dips. The market cycle comprises 4 stages: accumulation, markup, distribution, and fall. The accumulation phase is the time for buy-the-dip traders to initiate trades, and the distribution phase is the time for them to exit trades. Another bull trend with 3 phases based on the Dow theory is one in which traders aim to buy during the accumulation phase, hold on to their positions during the public involvement phase, and sell during the surplus phase. Market cycles can be recognized by both fundamental and technical aspects. There is a general fundamental 2-phase business cycle that shows the economy's overall expansion and contraction. The GDP and employment statistics are 2 essential indicators that can be used to track the business cycle. Utilizing several market technical indicators, such as Fibonacci tools, one may monitor the subjective psychological phases of greed and fear. Investors can use calendar cycles to time their market entries when purchasing cyclical trading equities on the drop. Market cycles can occur over long or short periods. The inability to consistently measure the frequency and magnitude of market dips is the major issue with the buy-the-dip stocks method. While looking at a chart after the fact can reveal several buy-the-dip opportunities in the market, it can be challenging to spot the finest ones when the market is open. Like other investment strategies, buying the dip has benefits and drawbacks. The possibility of large profits is what makes buying the dip so appealing. Investors who buy the dip beat those who buy and hold throughout market price peaks and troughs in an uptrend. There will always be opportunities to save money during market downturns. Long-term investors can also lock in a low average price of their preferred assets by buying the dip. Additionally, this increases the size of your profit margin. The approach is also perfect for trading specific markets that are prone to long-term high-value drops. Some stocks that offer valuable dip opportunities include technology stocks, cyclical stocks such as hospitality and commodities, and growth stocks that tend to be very volatile. The psychological kick of receiving a discount in the market is the last factor. Buying the dip will at the very least provide you the satisfaction and exhilaration of knowing that you did not buy an asset for the highest possible price. However, timing the market or buying the dip is a dangerous endeavor by nature. The size of a downturn is particularly challenging to estimate. There can be explanations for a dip, and you might find yourself caught in a full-fledged bear market. The reverse is also true. Waiting for a market decline could result in you missing out on significant gains during a prolonged uptrend. In general, it might be difficult to tell the difference between a brief market price decline and the start of a downtrend. Bitcoin prices can fall for a variety of causes, including governmental restrictions, community pressure, and political unpredictability. For instance, Bitcoin investment is declining as a result of the changes in the global economy. The global epidemic of 2020 halted commercial and economic activities, slowing down trade. Citizens withheld investing in anticipation of cheaper prices since they were uncertain about their future job. Additionally, there can be brief drops due to the news cycle. China started to crack down on Bitcoin miners in 2021, making it forbidden for them to conduct business there. Because there were fewer nodes to validate transactions, the majority of Bitcoin nodes had to shut down or relocate their operations, which made the Bitcoin network less safe. An asset can occasionally be simply overpriced and require consolidation of its prior gains. Traders can use technical indicators on price charts to assess whether a technical price correction is due to take place. One widely used technical indicator shows bearish divergence. Bitcoin was displaying technical price divergence before the top in April 2021, while the Relative Strength Index (RSI) indicator was showing lower highs. Higher price highs continued to form, especially after a protracted rally. An RSI divergence signals that a potential price correction may emerge. And as I said earlier, when a trader purchasing the dip notices this indication, they can decide to hold off on adding more coins until the price is lower. However, this back-and-forth market movement is endless. People will continue to buy the dip and wait for a rebound to sell, then repeat. Alright, guys, that wrap up our video for today. Give us a thumbs up and click the subscribe button if you found this video helpful and want to see more.